I'm really, really attracted to negative social media discussions of any one topic. The lady or the gentleman who posted saying that gold or silver never performs. I read comments all the time that says, when is gold going to move? To which my answer is, let me think. I think gold's going to move in the year 2000. Since 2000, gold has moved from $253 an ounce to a high of 27 something, currently around 26. What is that, a sevenfold return? Gold has done 8 and change compounded annually for 24 years. And some moron says, when is gold going to move? It always fails. That person is innumerate.
Gold has long been considered a strategic asset, particularly during economic uncertainty and rising inflation as governments, including the U.S., face escalating national debt and growing fiscal liabilities such as Social Security and Medicare. The role of gold in investment portfolios becomes increasingly significant with national debt at record levels and deficits ballooning the likelihood of inflationary measures to manage these obligations. Rice's Rick Rule, a financial analyst, underscores that the Federal Reserve's ability to create money through fiat currency has contributed to the current fiscal challenges. He argues that the fundamental issue lies in the reliance on fiat money, warning that continued monetary expansion could lead to economic instability. Historically, gold has proven to be an effective hedge against currency devaluation, particularly when inflation erodes the purchasing power of fiat currencies. Rule highlights the 1970s as a key example when gold prices surged from $35 to $850 per ounce due to inflation and a weakening U.S. dollar. This period was marked by rising government debt, increased military spending, and expanding entitlement programs, all creating inflationary pressures. Given the similar fiscal dynamics today, unprecedented levels of government spending, and growing deficits, it is likely that gold will continue to perform well as investors seek safe haven assets to preserve their wealth during financial instability. While gold can experience short-term volatility, its long-term trend has generally been upward. In recent years, gold prices have fluctuated, including a minor correction in 2023 from $2,700 to $2,600 per ounce. However, such fluctuations are temporary. Market adjustments and the overall trend remains positive as inflationary pressures continue to rise and government debt mounts. Gold remains an essential asset for portfolio diversification and wealth preservation. It offers protection against the decline in the value of fiat currencies, making it a critical investment for those looking to safeguard their financial future. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
Is unsustainable, and dealing with the debt is politically unfeasible. Now, we dealt with this as a people before, although the problem was less severe. In the decade of the 1970s, politically we couldn't raise taxes, but we had to pay for deficits, and we had to account for the debt brought up in the war in Vietnam, which of course we lost, and the war on poverty, which of course we lost. How did we do that? Well, in the decade of the 70s, according to the U.S. government, through inflation, we reduced the purchasing power of the U.S. dollar by 75% over 10 years. Not coincidentally, the gold price went from $35 to $850. The only way that we can service the nominal debt that we have as a people, particularly our entitlements obligation, is to inflate away the net present value of the obligation while leaving the nominal value intact. An old geezer named Rick Rule, 71 years old. I don't know what Social Security pays me, but let's say it's $4,000. You know, I was a high-income taxpayer. 10 years from now, they'll still pay me that nominal amount. They won't reduce it, although they can't afford to pay it. What they will do is they will inflate away the net present value of that nominal account. So my $4,000 will buy me $600 or $700, maybe $1,000 worth of goods and services. That's how you deal with that sort of thing. You either default honestly, you say to the bondholders and you say to the entitlement holders, too bad, so sad, money's all gone, strong letter to follow, or you default gradually by inflating away the net present value of the purchasing power. My suspicion is past this prologue, and we take door B, which is very good for gold. Gold in 2024? Who knows? Gold in 2025? Who knows? Look over 10 years. If you look back to the decade of the 70s, it'll tell you something about their trajectory. 1970 to 1972, gold went from being controlled to decontrolled, so it was $35 to $100. Gold went on a tear from $100 to $200, doubled. 1975, the Fed raised the interest rates. Gold fell from 200 to 100. End of 1975, the Fed lost their nerve politically, cut the interest rates. And that set off a romp at the end of 1975 that saw gold go to $850. Past in this case is prologue. Gold will go up and down, higher bottoms, higher tops. People who don't understand the process will be shaken out when gold softens up. By the way, the price decline from $2,700 to $2,600, that's a rounding error. It's truly a rounding error. 1975, the gold price fell from $200 to $100. That's a fall. People who got shaken out in 1975 missed a 5-year run from a $100 bottom to an $850 top. Folks need to give their head a shake. So I'm really attracted to negative social media discussions of any one topic. The lady or the gentleman who posted yawned, saying that gold or silver never performs. I read comments all the time that says, when is gold going to move? To which my answer is, let me think. I think gold's going to move in the year 2000. Since 2000, gold has moved from $253 an ounce to a high of 27 something, currently around 26. What is that, a 7-fold return? Gold has done 8 and change compounded annually for 24 years. And some moron says, when is gold going to move? It always fails. That person is innumerate. Mercifully for me, people who are probably smarter than me, that don't apply their brains to the task at hand, lose money while I make money.
Rick Rule highlights the potential within the silver market, particularly with junior silver mining stocks, which are known for their volatility and dramatic price movements driven by shifts in supply and demand. Junior miners in the precious metal sector have historically shown strong performance during bull markets, often outperforming the underlying metals. This outperformance can be attributed to their higher leverage to rising metal prices, as their fixed operational costs allow any increase in metal prices to boost profitability significantly. Therefore, these stocks present significant opportunities for investors seeking higher returns in markets with rising precious metal prices. Rule recalls his recent experience with the silver market, where the market reversed course sharply, despite widespread pessimism and a lack of funding for high-quality junior silver issuers, with sellers exhausted and sentiment shifting. Silver prices surged by 300% within just 9 months. This dramatic shift highlights the volatility and potential for rapid gains in the market, especially when the supply of sellers diminishes. Rule stresses that such market dynamics require investors to be prepared to act when the conditions are right, even if it means entering the market early, as these dramatic price movements can happen quickly and unexpectedly. Let's get back to the video. This script explores the enduring appeal of gold and silver as investment assets, emphasizing their historical resilience and future potential. Gold, often criticized for its perceived lack of movement, has in fact delivered a remarkable long-term performance, rising 7-fold since 2000 and achieving an annual compounded return of 8%. It has proven its worth as a strategic hedge against inflation and currency devaluation, particularly during times of economic uncertainty and escalating national debt. Drawing comparisons to the inflationary pressures of the 1970s, the narrative suggests that similar fiscal conditions today, marked by soaring government spending and deficits, could propel gold to new heights. Silver, meanwhile, is highlighted as an undervalued asset with extraordinary potential due to its dual role as a financial safeguard and an industrial metal. The increasing demand for silver in sectors such as electronics, renewable energy, and electric vehicles, coupled with constrained supply, sets the stage for substantial price appreciation. The script underscores the dramatic price swings and opportunities in the junior silver mining sector, where small shifts in the market can yield significant gains for investors willing to act decisively and endure volatility. The broader economic context paints a picture of a global financial system strained by debt and an over-reliance on fiat currencies, making inflationary solutions inevitable. As governments grapple with unsustainable fiscal obligations, gold and silver emerge as safe havens, offering protection against the erosion of purchasing power. The message is clear. While short-term fluctuations may test investors' resolve, those who maintain a long-term perspective are likely to reap the rewards of these enduring and valuable assets.